Welcome back to Turning Hard Times to Good Times. I'm your host, Jay Taylor, and I'm really happy to have with me once again one of our more regular guests, Alasdair Macleod. And so most of you know him as an ex-stockbroker, an ex-banker, and as an economist. He writes for Gold Money. He is a senior fellow there and head of research at Gold Money, and he writes a brilliant weekly commentary that I think is a must-read if you really care to know or to try to understand the reasons why markets are likely headed in the direction they are. Not just, you can say some people are satisfied enough to know which direction the markets are going and they don't want to know anything more. But those of us who really try to understand and try to figure out if someone is full of baloney or not, want to know the reasons for it and understand it. And Alasdair walks you through, I think, deeply into the reasons why things are happening and not just the fact that they are happening. So that's why I'm always so pleased to have him with us. Thanks for joining me again, Alasdair.
That's very much my pleasure, Jay.
It's always good to have you. And I want to talk to you today about an article you wrote on October 10th. This is primarily what I want to focus on, if we can. Monetary failure is becoming inevitable. And I'd like to just read the first couple of paragraphs of the introduction, because I think that really lays the groundwork, the framework for the article itself. And I quote, an unpleasant conjunction of events is beginning to undermine government finances in the more developed nations, including the arrival of a long-term trend of rising welfare commitments with an increasing certainty of a global-scale credit crisis. Those problems are, in turn, the outcome of a combination of the peak of the credit cycle and increasing trade protectionism. Few observers seem aware that an economic and systemic crisis will occur at the same time as government finances are already precarious. However, the consequences are unthinkable for the authorities, and for this reason it is certain such a downturn will lead to a substantial increase in monetary inflation. End of quote. Well, you started out your October 10th article stating that, as I just read, an unpleasant conjunction of events is beginning to undermine government finances in more developed nations. Perhaps you could just talk a little bit about what those events are.
Yes, certainly, Jay. I'm sure your listeners have heard me bang on about the credit cycle and all the rest of it. Mm-hmm. I mean, that is coming to fruition. But there is another aspect of government finances which hasn't been hitting the headlines recently, and that is the increasing cost of government welfare. And you may remember back in 2012 that an economist called Lawrence Kotlikoff estimated the net present value of U.S. government welfare liabilities to be in the order of $220 trillion. Yeah. He was admittedly the highest forecast, if you like, of that. I mean, but there were others saying it's going to be 100 trillion or 80 trillion or whatever. The key to this is to understand that these welfare commitments are now beginning to hit government finances, not just in America, but particularly in Europe and also in the UK. Now, the UK government has actually, for the last, I suppose, 15 years or so, started to try and address this by raising the age at which pension entitlement kicks in. This is for the state pension. Mm-hmm. In America, you've got some huge potential costs on the health system, as indeed we all have. It's not just America. Now, with these costs coming due, when you see that this welfare bill is now rising and accelerating, and at the same time we have a credit crisis in the offing. I mean, if you want a visible sign that this is developing, just look at what's happening with the German banks, the major banks. And I think if you looked at that, you would be convinced that there is something nasty, if you like, in the credit cycle likely to happen. If you put together those two things, a credit cycle which is turning sour, and that would inevitably lead to a weaker economy, both for America and also for other nations, and these welfare commitments rising, you can see that very rapidly, government finances are going to get into a very, very deep water. And that was really the thrust of the article. It was the conjunction of these two things coming together like two icebergs, sort of about to crash into each other. And, we're probably sitting in a boat sort of watching one coming from one side, another iceberg coming from another side, and guess who's going to get crushed? Can we row out of the way quick enough?
The icebergs have a way of surviving.
Well, yeah, exactly.
Yeah, and so you have the credit cycle, which suggests that if you have a credit cycle, anything halfway as severe as we had in 2008, 2009, some people, I think, probably including yourself, think it could be a lot worse this time, given the dynamics, given all the debt and all of we've never solved anything in the past. We've only just layered it on. So you have the credit cycle, which suggests decreasing earnings or decreasing revenues for government, decreasing tax revenues at the same time that you have this dramatic increase in expenditures by government for the welfare state. I suppose some of that has to do with the aging population and the reducing number of younger people producing and paying into it. That's certainly what the Western world seems to have, is the aging of their population, right?
Yes, that certainly doesn't help. But I think by far the most important thing is okay. I mean, we accept demographics, and indeed that must be part of any economist's forecast of the net present value of those future liabilities. But I think the real problem is that those costs are now sort of beginning to come through, and the problem with the credit cycle is that the dynamics behind it are far greater than the dynamics behind the Lehman crisis back in 2008. And on top of that, we've got a touch of the Smoot-Hawleys. Now, Smoot-Hawley was the Tariff Act, which was passed by Congress on the 31st of October, 1929. And that was the month when Wall Street crashed. It could see this one coming. And and nobody's really researched this, but it looks to me, every way I look at it, there is a synergistic effect, if you like, where 1 and 1 equals 3, where you combine the credit cycle, which peaked in 1929, with a jacking up of tariffs and trade protectionism, and you're going to collapse the economy. I mean, it's really as simple as that. And so I'm afraid that the comparison with 1929 to 1932 is really quite alarming. And on top of that, you've got a welfare state, a costly welfare state, which is considerably more expensive than any welfare payments that were paid out in 1929 to 1930s. So you can see that there's a conjunction of events here which we haven't seen before. Now, we just hope we can navigate our way through it, but I would be rather skeptical about attempts to do that being successful. I mean, the first thing that is likely to happen is that a bank will get into trouble. Now, the reason I focus on Germany is really twofold. Firstly, we know that the major banks, and particularly Deutsche Bank and Commerzbank, you've just got to look at their share price, and they've got problems. We also know that the German economy is tipping rapidly into recession because their major customer is China, and China is not buying autos anymore. So the German economy is tipping into recession. Now, we do know, therefore, that these banks are going to have an increase in non-performing loans. They're going to have, sort of other problems related with their commercial lending, and and this is. After or on top of all the problems that Deutsche Bank and Commerzbank have had, which has driven their share prices down to a tenth of their highs. So you can see that it's quite a nasty situation there, and if confidence starts being eroded in the banking sector in the Eurozone, it's not just the German banks. I mean, there are quite a few others. Now, having said that, I don't actually think that Deutsche Bank will just go bust and all depositors will sort of face getting nothing. What I do see is it will be rescued, it will be nationalized, or it will be supported by the German government or something. But this is a rolling situation, and in another article I compared it with the Credit crisis in 1932, I think it was. Now that was Credit had been put together out of a number of bust banks or failing banks, and eventually it failed as well. So if you look at the Deutsche Bank example, Deutsche Bank and Commerzbank, perhaps they may be sort of merged into a super bank with a certain amount of government money chucked in it. But then it'll fail again. This is the problem. And, in 1932, we had Credit in Austria, which is a relatively small country in Europe. This time, Germany is a far more serious matter. So, in the sense that there is room for dropping the ball through this credit crisis, I think we should be really quite wary of having money in banks, if you like, in the more general sense.
Yeah, for sure. People don't realize that they're really unsecured creditors to the banks, and it's not really their money once they put it there.
That's correct, yes.
Yeah, I think the article that you're referring to is your September 27th article, and people can go there at goldmoney.com and read it, The Ghost of Failed Banks Returns. I think that's the article you're referring to. Recently there's been some unrest in the repo market, in the U.S. Treasury repo market. Do you think those are perhaps some tremors of what you're talking about?
Yes, I do. I've got a little anecdote. We had a bank in this country called Northern Rock, and I think it was in December 2007. I happened to be sitting in the offices of one of the large money brokers in London, and I was suddenly told by the dealers that the interbank market had seized up. Oh. And nobody really knew why. And I sort of thought, well, to me, this was actually a very serious thing because as a follower of Austrian economics, understanding banks, understanding banking cycles and all the rest of it, when you get the liquidity in the market, in the wholesale money market, effectively disappearing, this is a very serious issue. 2 months later, it was 2 months later, it was in February 2008, Northern Rock appealed to the government to be rescued, and it had to be taken over by the government. That was 2 months from that point. Now, you can't definitely say the reason that the interbank market seized up was because Northern Rock was going bust. No, but you can see that the situation is an interesting coincidence. Let's put it that way. This time we have another coincidence, and we have the repo market failing. Now, the repo market is a lot bigger than the interbank market in London, because the interbank market in London is an unsecured liquidity market. You don't have to put up any collateral. Basically, you have credit lines with all the major banks you're likely to deal with in the LIBOR market. In the case of the repo, this is the numbers are far, far bigger. Now, it so happened that the day the repo rate shot up to 10% was the day when Deutsche Bank formally sold, it completed its sale of its prime brokership to BNP. Now, you can imagine, I can imagine that under those circumstances, the deposits which are held on Deutsche Bank's prime brokerage business, and these would be other banks, it would be hedge funds, whatever. They may not actually travel with the business being sold. So you can have a situation where someone is left, without any funds, and they need to cover. And I think that the coincidence of the events, I think, is interesting. But going back to the Northern Rock thing, I just see a seizing up of the markets, in the wholesale money markets, and you count 1, 2, 3 months, whatever, and you got a problem. And that's what happened last time, and that I think could well happen again.
Alasdair, why do you think so few people see this? I mean, to quote your opening remarks in this article, few observers seem aware that an economic and systemic crisis will occur at the same time as government finances are already precarious. Well, I mean, the things you're talking about, they're not particularly new. Why do you think people can't put 2 and 2 together on this?
I think it's vested interest. I mean, if you're an investment manager, then basically your livelihood depends on you being bullish. Yeah. So, dare you think of anything else? No. And I think if you're an ordinary person, you just go about your day-to-day life. You don't necessarily think about these things too much. You don't want to address something which is likely to be a problem. You don't want to sort of anticipate something nasty. Very, very few people do that. Most people go through life sort of happy-go-lucky. I mean, look at the number of people. 78%, I think was the last number I saw in the United States, of people on salaries live paycheck to paycheck.
Yeah.
Hold on a minute. Is that so? Are those people actually thinking something might go wrong? No, they're not. And I really think that you've got this sort of human nature, particularly when governments basically rescue everything. We're never going to have a problem because the government says so. The government will sort it out. No, they won't.
Yeah. Ultimately, they won't. They seem to paper things over for a while, and and I guess you wouldn't if you were, say, working for J.P. Morgan or somebody, go on CNBC and start talking in negative terms, because it could actually start to trigger things too. So you don't want to be the one that starts the avalanche from going down the mountainside.
Good heavens, no! I mean, can you imagine?
So Alasdair, here's the thing now. As you say, this is going to come as a shock to the authorities. And how will they respond? I mean, we can probably judge that they'll respond. The central banks will start printing money like mad again, right? And then what happens to interest rates? Do we keep seeing interest rates plummet, go down lower and lower, at least for the start?
There is if you like, there obviously is a conflict here, because as the rate of money printing ramps up, we would expect the purchasing power of the fiat currency to diminish.
Right.
Now, under those circumstances, interest rates should rise. Mm-hmm. So I think what you'll have central banks with a real problem. The market will be demanding higher rates. In other words, the government won't be able to fund itself at the rates which. Sorry, so I just had an interruption here. The government won't be able to fund itself at anything like the rates which the Fed is trying to force on the markets, then you'll have an unfunded situation, which then reverberates into the foreign exchange markets. So you can see that a government crisis in funding could arise very, very rapidly by the necessity so bond yields down so the government can fund itself.
Yeah, sorry. And also what you've talked about recently with respect to the world's reserve currency, the dollar, at some point in time, as rates decline, the dollar becomes something people don't really, it seems as though it's likely that people won't want it. You talked about the normal interest rates, or the time preference rates, as you put it, that gold has a 1.5% to 2% preference rate, and everything, as you pointed out, commodities have a preference rate. Do you see the possibility then of a dollar that is no longer in favor as the world's reserve currency, thereby leading to the destruction of the world's reserve currency, and as measured in that currency, commodities rising very dramatically, we might have an inflationary problem?
Yes, I think that's almost certainly going to happen. Quite how we get there is something which is a matter of debate. Yeah. But bear in mind that the U.S. budget deficit has been financed almost totally by foreign purchases of dollars. Now, with global trade contracting, there is no need for foreigners to buy more dollars. If anything, they are overweight dollars. And the interesting thing is that this was a point that Mark Carney was making at his Jackson Hole speech, when he was saying that too much money from emerging market economies is tied up in dollars. They should be released so that investment, if you like, can continue. Now, he actually said that at Jackson Hole. I thought that was quite brave, but but it does highlight a problem, and that is that the world is one way or another moving on from the dollar being the reserve currency. We don't know how quickly it'll happen, but at this time, the government borrowing requirements are likely to escalate. This is not good news.
No, and where is the money going to come from to finance that if foreign credit isn't forthcoming anymore? The Chinese and others, the Japanese too, for their own reasons, don't have endless resources to keep buying and financing U.S. living beyond its means. The scale of the problem is to be grasped, you talked about, with just a minute or two left here. What is this going to mean? And we could see, the timing is impossible to know. This idea of the world's reserve currency, everybody that I talk to, financial people say, well, Taylor, you're just smoking something funny because there's no way any other currency has the liquidity to go to as the world's reserve currency. What do you say to people that say that?
Well, they're making a statement of the obvious, and this is the real problem, I think, that central bankers have. They're hooked on the dollar, and they don't really know what the replacement is. Yeah. You've got three blocks, really, haven't you? You've got the dollar, you've got the euro, and you've got the yuan. Now, if the dollar's going down the tubes, then either the euro or the yuan has got to take over. And do we want either of those?
I don't know. I don't think so.
It's quite a problem, isn't it? So I can see that there's going to, in terms the geopolitics of finance, I think is another issue which is rapidly coming up and could be a major problem. Now, after the next credit crisis, then this is really going to come into focus.
Okay, 30 seconds. Short-term interest rates heading down, lower.
Short term, yes, manipulated down, yeah.
And so the equity market could remain strong for a little while longer. It should be good for treasuries and for gold in the short term.
Yeah, basically, I'm not too sure that it would be good for yields. I think the Fed can sit on interest rates at this level, maybe even bring them down a notch in December, sort of thing. But I think that markets have really discounted this game, I think, quite a long way now. And I think from here, if we get more evidence that the economy is tanking, then I think that will probably start driving equities.
All right. We'll have to leave it go at that. Thank you so much, Alasdair, for being with us. Always a pleasure having you. Always interesting, stimulating discussion when you're with us. So I thank you very much and look forward to doing it again sometime very soon. So thank you very much again.
Thank you, Jay.